Welcome to The Explainer. Today, we're going to talk about a problem that, let's be honest, is a pretty good problem to have. What do you do with your savings after you've already maxed out your 401k and your IRA? Well, one potential answer is something called a non-qualified annuity. So you're doing everything right. You're a diligent saver, you're hitting those contribution limits every year, and you still have money you want to invest for the future. You've hit a wall, right? So where does that extra cash go? Let's explore one really powerful option. All right, here's the game plan for today. We're going to start with the puzzle itself, then introduce this unique retirement tool. We'll get into the rules of the game, compare it to what you already know, and wrap up by weighing all the pros and cons. Okay, so let's really set the stage here. You've got money you want to save, but here's the catch. You've already paid income tax on it. And those easy tax advantage doors for your 401k and IRA, they're closed for the year because you've already hit the limit. This is exactly what we call the after-tax savings puzzle. So, what's the solution? Well, let's dive into a tool designed specifically for this situation. It's called a non-qualified annuity. And you got to know, it works a little differently than the retirement accounts you're probably used to. It's built from the ground up for this after-tax scenario. So here's the core idea, the big aha moment. You use money you've already paid taxes on to fund it. But the magic happens while it's in the account. Its growth is tax-deferred. Think about that. That means no annual tax bills on your interest or your gains. It just gets to compound year after year. You only pay tax when you actually take the money out. So where's this after-tax money coming from? Well, you've got a lot of flexibility here. It could be cash sitting in a savings account, money from a brokerage account, maybe you sold a piece of property. The one thing to burn into your memory is that you cannot roll over money directly from a pre-tax account, like a traditional IRA. This is strictly for after-tax dollars. Now, annuity isn't a one-size-fits-all kind of deal. There are a few different flavors. A fixed annuity is the simplest. Think of it like a CD from an insurance company. It gives you a guaranteed interest rate. Then there's fixed indexed, which links your returns to a market index like the S&P 500. So you get some of the upside potential, but, and this is key, your principal is protected from losses. And finally, you have variable annuities. These are the most aggressive. They let you invest directly in sub-accounts that look and feel a lot like mutual funds. They have the highest growth potential, but also the most risk. You knew this was coming, right? Anytime you get a sweet tax advantage like tax deferral, there are gonna be some rules to play by. So let's get into the nitty-gritty of taxes and withdrawals, because how you get your money out is just as important as how you put it in. Okay, lean in for this one, because this is probably the most important rule to get your head around. When you take money out, the IRS uses what's called a last-in, first-out rule, LIFO. That means the very first dollars that come out of your account are considered your earnings, and you'll pay ordinary income tax on them. It's only after all of your gains are out that you finally start getting back your original investment, your principal, which, thankfully, comes back to you completely tax-free. And here's the other big one. Just like with an IRA or 401k, the IRS really wants you to use this money for retirement. So if you pull out your earnings before you turn 59 and a half, you're likely going to get hit with a 10% penalty. And get this, that's on top of the regular income tax you'll already owe on those gains. So it's a double whammy you want to avoid. But look, it's not all doom and gloom. The IRS knows that life happens, so that 10% penalty isn't written in stone. There are some important exceptions. For instance, if the owner becomes disabled or passes away, that penalty is waived. It's also waived if you decide to annuitize it. That's a fancy word for turning your lump sum into a guaranteed paycheck for life. You know, one of the best ways to really understand something is to see it right next to what it's not. So to get a handle on what makes a non-qualified annuity so unique, let's put it side by side with its more common sibling, the qualified annuity. That's the kind you'd find inside an IRA or 401k. See, this chart makes it all crystal clear. With a qualified annuity, you're using pre-tax money, and you have those strict contribution limits. The trade-off is that every single dollar you take out in retirement is taxable. With a non-qualified annuity, it's flipped. You use after-tax money, but, and these are huge, there are no contribution limits, and only the earnings are taxed. And here's the other giant difference. No required minimum distributions, or RMDs. The IRS isn't going to force you to start taking money out at age 73. You are in the driver's seat. All right, we've covered a lot of ground. We've defined the tool, we've walked through the rules, we've done the side-by-side comparison. So now, let's just put it all on the table and weigh the good against the not so good. This right here is the central trade-off. The pros are incredibly powerful, that tax-deferred growth, absolutely no limits on how much you can put in, and no RMDs giving you total control. But you have to weigh that against the cons. Your earnings are taxed as ordinary income, which is usually a higher rate than long-term capital gains. You've got that 10% penalty looming if you need the money early. And let's be real, these can be complex contracts, sometimes with high fees or confusing features, so you have to do your homework. So, if you're going to walk away remembering just a few things, let it be these four. 1, this is a tool for your after-tax money. 2, it's tax-deferred growth, not tax-free. That's a big distinction. 3, its greatest strengths are flexibility, no contribution limits, no RMDs. And 4, you absolutely have to plan around the withdrawal rules. Gains come out first, and that 59.5 age marker is key. And that really brings us to the final question you have to ask yourself. For a saver who's already maxed out all their other options, the power to let even more money grow without getting a tax bill every year can be a game changer. But it comes with a very specific set of rules and trade-offs. The answer, as it always is with personal finance, really depends on your own situation and what you're trying to achieve long-term.